Hi everyone, Happy New Year! So first of all, I want to wish you all a very successful and healthy 2026. So today I want to break down Meituan, a company I've been following closely and that a lot of investors are debating right now. Meituan sits at the center of China's local economy, turning nearby demand into instant transactions across food delivery, instant retail, in-store services, and travel by matching consumers with merchants and coordinating fulfillment at scale. And as we saw in my previous video on JD, this sector is now in a fierce price war. So in this video, we'll look at how Meituan has been impacted and whether it's still a good long-term bet. Meituan didn't start as a delivery app. It started in 2010 as a group buying platform, basically training Chinese consumers to pay online for offline consumption. Over time, that local commerce DNA became the foundation for its most important move, entering food delivery in 2013 and scaling an intracity on-demand network that could serve millions of small merchants. In 2015, the merger with Dianping created a much broader local services champion. Deals, discovery, reviews, booking, all feeding the same habit. Open Meituan when you want to do something nearby. The company listed in Hong Kong in September 2018. And since then, the strategy has been consistent. Management frames Meituan as retail plus technology, a platform that connects consumers with local merchants across high-frequency categories, then uses logistics and data to expand the basket beyond meals. All of that history shows up in one place, the top line. On the revenue chart, Meituan scales from roughly 65 billion RMB in 2018 to about 338 billion RMB in 2024. That's a 31.5% CAGR over 6 years, which is exceptional for a company that's already operating at national scale. The more recent prints also show a clear deceleration. H1 2025 revenue was 178.4 billion RMB, plus 14.7% year-on-year, while Q3 2025 revenue was 95.5 billion RMB, plus 2% year-on-year. At this stage of scale, growth naturally becomes more uneven quarter to quarter, and it becomes increasingly shaped by competitive intensity and promotion levels, not just underlying demand. On EV to revenue, the market has derated the stock significantly since 2020. The multiple is now around 1.6x on the chart. To understand how Meituan makes money, keep a simple split in mind. Core local commerce is the profit engine, and new initiatives is the investment engine. In the core segment, Meituan monetizes local transactions through a mix of delivery service revenue, commissions, and online marketing sold to merchants. That's where the business model is already proven and where profits are structurally generated. New initiatives, by contrast, is where Meituan funds newer growth vectors, notably grocery retail and newer formats. It's typically loss-making early on, but strategically built to expand user frequency, merchant coverage, and long-term optionality that can later reinforce the core flywheel. On the cost side, the key point is scale doesn't mean light. This is a fulfillment-heavy model. In 2024, cost of revenue was approximately 61.6% of revenue, versus approximately 19% for selling and marketing, with R&D 6.2% and G&A 3.2%. That business model split, core local commerce as the profit engine, new initiatives as the investment engine, also explains why profitability is a relatively recent chapter for Meituan. For years, the goal wasn't to optimize margins, it was to build density. More users, more merchants, more riders, higher order frequency. In a fulfillment-heavy model, that usually means incentives and marketing come first and profit come later, once the network is dense enough to monetize efficiently. The EBITDA margin and EPS charts make that late profitability pattern very clear. From 2018 through 2022, the earnings profile is volatile and often negative. The business is still in build-out mode. Then, 2023-2024 becomes the proof of concept. Meituan starts converting scale into real profitability, with EBITDA margin stepping up to 14.6% in 2024 and EPS rising to approximately 5.85 RMB. But 2025 is the reminder of what this industry really is, a competitive battlefield. In H1 2025, Meituan still posts an 8.5% EBITDA margin, already a step down versus 2024. Then, Q3 2025 is the shock. Adjusted EBITDA turns negative, minus 14.8 billion RMB, and adjusted net profit flips to a loss, with the company pointing to intensified competition and higher incentives in its core battlefield. Now, why did JD and Alibaba decide to pay for this war? Because instant delivery is becoming the new front door to commerce. If you win the high-frequency order, meals, groceries, daily necessities in 30-60 minutes, you win habit, traffic, and merchant mindshare. That's why JD pushed into food delivery in 2025, including a very aggressive merchant offer, effectively zero commissions for early signs up, to full scale quickly. And it's also why the fight isn't one way. Meituan's expansion in instant retail keeps creeping into categories that used to feel owned by traditional e-commerce, including 3C, electronics, and appliances, which increases the strategic threat to JD's core identity. Alibaba's logic is similar. It doesn't want Meituan controlling the one-hour consumer relationship, so it leaned on Taobao instant commerce plus Ele.me and escalated subsidies to compete head-on in rapid delivery. On China e-commerce, JD's share has been slowly sliding as the market gets more fragmented. Price-first platforms and content-driven shopping are taking a bigger slice, which makes it harder for JD to defend traffic using the old playbook. And in food delivery, Meituan is still the clear number one. But the chart shows why new entrants still matter. Even if JD's level of around 5%, that can be enough to trigger a brutal reaction. Because the real weapon isn't market share on day one, it's subsidy intensity and the pressure to convert users. At that point, the price war stops being a narrative. It becomes a balance sheet game. Meituan ends 2024 with 70.8 billion RMB cash versus 55.8 billion RMB gross debt, i.e. still net cash on the structure chart. So it can fund aggression for a while, but Q3 2025 shows the cost of war in real time. Net cash used in operating activities was 22.1 billion RMB in the quarter. In other words, Meituan has the resources to defend share, but the burn rate can accelerate fast when incentives become the main growth lever. So stepping back, Meituan's profitability is a recent story. The business only starts to look meaningfully profitable in 2023-2024, and 2025 is a reminder of how quickly a price war can reset the margin profile. The real question isn't what Meituan earned last year, it's what Meituan is becoming. And that's exactly why it fits my long-term thesis, the singles economy. Japan is often the cleanest preview of what happens when household formation weakens and solo living becomes normal. The key point isn't just fewer marriages, it's that the default consumption unit shifts from family to individual, and that changes demand in very predictable ways. Smaller baskets, higher frequency, more convenience, more willingness to pay for friction removal. The household data captures that direction. Japan's projections show 1% households rising from 38% in 2020 to 44.3% in 2050, with around 23.3 million single-person households by 2050. When that becomes the baseline, consumption patterns don't disappear, they reallocate. People still eat dinner, still buy basics, still book leisure, but spending gets more fragmented and more service-heavy. Ready-to-eat meals, delivery, last-minute top-ups, solo leisure, and time-saving purchases after work. Culturally, Japan even has a vocabulary for the one-person market, Ohitori-sama, which reflects how normalized solo consumption has become. China is not Japan, but the structural direction is increasingly similar. Delayed marriage, fewer household formations, more solo living, and a bigger share of small households. Academic work using census-based sources notes that one-person households reached approximately 125 million in 2020, about 25.4% of all households. And the marriage data is moving the wrong way. Marriages fell to 6.1 million in 2024, down about 20%, the lowest level since records began. That combination matters economically because smaller households typically imply more frequent purchases, less storage, less bulk buying, smaller ticket sizes per order, but more orders. Higher value of convenience, delivery, speed, one-click solve it, a shift towards services and instant fulfillment rather than planned weekly shopping. And there is a second-order effect. When household size shrinks, patterns of consumption shift measurably, including toward convenience-oriented behaviors, which is why household miniaturization is studied as a driver of product consumption changes. This is where Meituan fits. A singles economy is, by definition, a high-frequency economy. It rewards platforms that sit on daily habits, dinner decisions, I forgot something purchases, pharmacy top-ups, small grocery loads, and last-minute local services. And that is exactly what Meituan is built around. If more consumers live alone, the default mode becomes smaller baskets, less planning, more reliance on instant delivery and local fulfillment. Instead of one big weekly shop, you get repeated micro-orders, and Meituan monetizes micro-orders well because it sits in the transaction flow and it sells merchants the tools to capture that demand. The long-term thesis, then, isn't singles spend more, it's more specific. Singles spend differently, and they disproportionately spend on convenience, speed, and friction removal. That demand pattern naturally expands the relevance of Meituan's core: food delivery, instant retail, and local services, the exact categories that become more habitual as households shrink. Another interesting part of Meituan's story is its expansion overseas. Meituan's international strategy is still early, but it's clearly centered on exporting the core playbook through Keeta. The logic is straightforward: take what worked in China, merchant density, fast dispatch, and heavy execution, and test it in markets where delivery penetration is still rising. What matters here is that Meituan didn't just build an app. Over the years, it built a highly efficient delivery operating system: dispatch, routing, merchant tools, and it keeps improving that stack with AI. China's scale helps. Operating across densities and a massive user base generates huge volumes of data that can continuously refine the model, improve ETAs, and raise utilization. If Meituan can carry that software and operating advantage abroad, overseas becomes a real long-term option. Not a near-term profit driver, but a second growth curve built on a proven execution engine. In terms of recent news, the key updates from late 2025 are less about who is fighting, we covered that before, and more about what this fight does to Meituan's strategic bandwidth. The price war is not only a margin story, it's a cash allocation story. When incentives spike and operating cash flow turns negative, the first constraint isn't valuation. It's how much cash you can still deploy into long-term projects without weakening your balance sheet. That matters directly for overseas expansion. Keeta may be a credible second curve, but it competes for capital against a domestic battlefield that is consuming cash in real time. So one of the major risks of an extended price war is that it doesn't just delay profits, it can also slow the pace of international scaling and force management to prioritize defending China over building the next growth engine. Valuation is hard with Meituan because free cash flow has been volatile, and it only becomes meaningfully positive in 2023-2024. The chart makes it simple: weak or negative through 2021, positive in 2022, and then very strong in 2023-2024. That's why today's price to free cash flow is basically a 2024 based multiple, about 12.5x on the chart. For a scale platform that fits the long-term thesis we discussed, that looks attractive. But 2025 is a different regime. In H1 2025, free cash flow was still positive at roughly 9.4 billion RMB, operating cash flow 14.9 billion RMB, minus capex 5.6 billion RMB, while Q3 2025 shows a sharp reversal, with operating cash flow alone at about minus 22.1 billion RMB, meaning free cash flow for the quarter was deeply negative. At today's price of around 104 Hong Kong dollar, Meituan trades at roughly 16x financial year 2024 earnings. The market has already punished the stock for the weak 2025 prints, and management has been clear that the next few quarters will likely remain impacted by the price war as well. So for now, there is no clear visibility on when this irrational competition actually ends. The main risk is that if the pressure continues quarter after quarter, the market simply loses patience, and even a great long-term thesis won't get rewarded until the competitive intensity finally cools down. Personally, I own the stock, and at around today's price, I'm still adding. The long-term setup we discussed, a platform sitting on high-frequency local habits, in a world moving toward more convenience-driven consumption, still makes sense to me. And if this price war drags on and the stock goes lower, I will treat that as an opportunity to accumulate. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share. And if you want to dig deeper into another company being hit by China's price wars, check out my JD.com video.